All right. Hey, thank you so much for listening or attending this class on non-qualified mortgages and what knowing about and being able to utilize a non-qualified mortgage can do for you and your business and your own customers. That would fall into that non-QM category. So, just a quick introduction. My name is Jed Barker. I am the owner and founder of Vivid Mortgage. We're a local mortgage brokerage right here in Greenville, South Carolina. Take care of qualified and non-qualified mortgages throughout the upstate and throughout the state, stuff like that. I have a little picture here that you're seeing right now on the screen. Just something I threw up there. Talks about how we love to be heroes to our clients and help close loans that others can't. And that's a bit about non-qualified mortgages. Not everyone does a non-QM loan, in the industry. If they were to call, Quicken Loans or a Rocket Mortgage or various other lenders or mortgage brokers, they may not find a solution to their problem, which is getting a loan for the home they want to buy. So a little bit about my commitments as a mortgage professional, as a sales professional. Communication is key. Always communicate. Always stay ahead of schedule. I believe the universe likes speed. It likes us to be quick at what we do and make decisions. So I'm all about that. Always be solutions oriented. Don't fit yourself inside a box. Try to stay out of the box and always be team oriented. Work as a team, communicate well, stuff like that. Um, so I wanted to say, what is a QM mortgage? What's a qualified mortgage? Well, that's what you would know as your all your regular financing that you're used to. Your FHA loan, your USDA loan, your conventional, certain jumbo loans, 30-year fixed terms, 15-year fixed terms. They stay within conforming limits, and they have traditional ability to repay standards such as W-2s, tax returns, pay stubs, all that kind of thing. Those are your normal qualified mortgages. That's probably the majority of the loans of the borrowers that you're helping buy homes will need a qualified mortgage or will qualify for a qualified mortgage. But there are those, and it's a growing segment, which I'll show you, of that won't qualify for a qualified mortgage, but they absolutely could qualify for a non-QM loan. Okay, so I'm going to go ahead and start this presentation and we'll get into it. So what is a non-QM or a non-agency loan? A non-QM or non-agency loan is a bank. Here's some categories of what they could be. Number one, it could be a bank statement loan, 12 or 24 months of bank statements, as opposed to using a tax return or a W-2 to qualify for income. It could also be asset depletion, someone who is heavy on the assets but low on the income. They couldn't qualify for a qualified mortgage, but they could qualify for a non-qualified loan. Investor advantage loans are those loans for investors, whether that be a hold and rent strategy or fix and flip rehab. Non-qualified mortgages are wonderful for your investor clients who cannot qualify for those loans based off of their income. We'll talk about that as we get into it. Or maybe you're just missed jumbo clients, those who are getting jumbo mortgage, but they're just missing out on DTI limits, or maybe they don't have 20% down, those kind of things. Those can be taken care of on the non-qualified, okay? Most qualified mortgages need 1-2 years of documentation, such as 2 years income, 2 years taxes, 2 years W-2s. 1 year could be all that's sufficient under non-QM guidelines, that kind of thing. So also different terms, 40-year terms, interest only. Those are terms that could be available, or people that have recently had a bankruptcy or foreclosure. All of those could be falling in that non-QM category. So I want to take a moment and tell you what non-QM is not, so you don't need to worry about it. It's not just a stated loan, a NONA or a NINA, some things that were out there back in the 2006, 7, 8 crisis of the real estate market. People getting houses couldn't actually afford them. That's not what it is. It's just qualifying people out of conventional standards that still qualify. Okay, it's not a negative amortization loan. We're not trying to get people into trouble. Okay, that's not what it's about. It's not prepaid penalty loans, those kind of things. On the consumer side for primary housing, no prepaid penalties. Now on investment loans, there could still be prepaid penalties. People have their options on that for different interest rates. Okay. It's not difficult. You'll see the sad face. These aren't difficult loans unless you don't know how to do them, unless you're not experienced in them. And they could be difficult, but they're not difficult. They're not predatory. They're not for borrowers that have low credit score, and they're not super high interest rates. Okay, that's what they're not. So what we've already talked a little bit about what they are, and now we talked about what they're not. So let's go a little bit about the history of non-QM. Maybe why you haven't really done that many of them in your work history as a real estate agent. and why you need to know about them now. Okay, so look at this history in years on the bottom from 2014 to 2019, and we can call that 20. We just got into 20, and also the volume of transactions on the side. Okay, so look at that. Back in 2014, pretty much non-QM is non-existent in the marketplace. 2015, non-existent. 2016, we're getting back into there with about $1 billion of non-QM financing happening. 2017, about $4 billion. Maybe that's where, yeah, there you go. You look at that, and then in 2018, look at that jump, boom. And in 2019, in 1 year, it doubles. I will say to you, projections that's going to go double again in 2020, and we're going to be going further and further. So why is it doubling? Why the need for the non-QM market? What is it fulfilling the needs of? Well, it's fulfilling the needs of this economy right here. You guys have heard of this, I would assume so. The self-employed gig economy, those who are not traditionally employed, with a W-2, those who are doing things such as Uber drivers. Think about real estate agents. You're self-employed. You have a 1099. All those gig employment jobs where they're self-employed business owners now. There's just so much of it out there, and so much of that. Basically, those people are having a hard time qualifying for mortgages because they don't fit it inside the box, right? So these non-QM loans are perfect. So QM loan guidelines, if you look on the left-hand side under QM loan guidelines right now, traditionally you have to have a 2-year W-2, 1 to 2 year tax returns. You need to have qualifying income. Your debt to income ratios, they're going to be very important. But on the non-QM side, which is the right side of the screen, you can do bank statement loans as opposed to 2-year W-2s, which takes really adds a world of difference. So I'll give you a quick example. I had a client of mine who was getting turned down by the bank for a home he wanted to purchase. Now, the home he wanted to purchase was about $950,000. He's in business for I think about 4 years, so he needed to show 2 years of tax returns. But he came off a good year, but the year before that was not as good. He had a lot of write-offs and stuff like that, but he's coming off a good year. He's feeling really good about his business. But the bank says, you know what? You add these 2 years together, you only qualify for about $150,000 mortgage. Not going to work for him. He quickly realized that he wasn't going to qualify. He got very discouraged. But then he met a friend who was a friend of mine who said, you need to call Jed. He does different kind of fundings for business owners. We quickly ran him through a qualification factor on a business bank statement program and had him into that home for $950,000 35 days later. World of difference. Changed his life, he said. And we used a 24-month bank statement program for his business. He had good cash flow in his business. He had a great FICO credit score. He did 20% down. And it was amazing, to have him do that. 7 months later, he did qualify for a conventional mortgage, and he ended up refinancing with us out of that non-QM loan to a traditional mortgage for a much better interest rate. But it was worth it to him to pay a little bit of interest rate to get into the home he wanted to buy quicker. Does that all make sense? Okay. So that's just one category. You're self-employed borrowers. There's a lot of them. You as a real estate agent, you are one of them. If you've ever experienced trying to get a loan, but you've had a lot of write-offs and your income doesn't look as much as it really is, that could be an issue, right? So how does that non-QM 24-month bank statement work? Easily, you look at the cash flow going through the bank account, you add it all up, you divide it by the number of months that you're looking at, and that is the income, as simple as that. Okay, so let's go ahead and move on. A little bit, I'll throw the screen up here just for a minute, guys. Bank statement program shows you the LTV guidelines, up to 90%, 85%, 80%, 70%, the loan amounts that are available. You can do ARM and fixed interest rates, everything like that. DTI ratios up to 50%, sometimes 60 with high enough credit scores and low enough LTV. As far as that goes, 2 months bank statements is available, although you better interest rates on 12 and 24 months. And we use 100% of the deposits, so we don't have a factor in there. So a very good, excellent program to look at for your self-employed borrower. The next one I wanted to show you is your heavy asset, light on income. Maybe these are your baby boomers. Those are going into retirement, have retired. They don't have a lot of income left, if any, but they do have a lot of assets. We can take those assets that they have and split them up over 5 years and qualify from that mortgage. A lot of people are beginning more and more to fall into that category as these baby boomers age. So think about that when you have a borrower who is possibly moving down, maybe downsizing as an older person downsizing and they want to get a mortgage as opposed to pay cash, but they're having a hard time qualifying. They probably have the assets to qualify, but not under traditional financing. Under traditional financing, they'd have to go out 360 months, which would wipe them out typically for a lot of people. But 20 months worth of asset depletion is where it's at. So think about that for these people if you run into them and if you serve them. Next one, Investor Advantage. This is one of my favorite programs. On an Investor Advantage loan, you can do up 1 to 4 unit properties. You do not have to qualify off income standards, so no income documentation, no W-2s, no tax returns, anything like that. We do not care about income from a personal standpoint. What we're looking at is a DSCR ratio, so a debt service ratio on the property. Does the property appraise? Will it rent out for the mortgage? We're really looking at 115% value of the rental compared to the mortgage. If the client has a passing credit score and a few other factors, they can qualify for an investment property, buy and hold, or a rehab without having to have income guidelines. So this is a huge win for your investor clients who are looking to buy more and more investment properties without income guidelines. Okay, so we'll look at that. Keep that in mind. Those are the 3 programs I wanted to share with you today. Keep it pretty short and simple. I know you might have questions, so if you do, please consider reaching out. You can reach me on my cell phone at 864-800-9251. Our website is vividmortgagecorp.com. That's VIVID MOR it's mortgage, MORTGAGECORP.com, everything like that. Visit us there, or just shoot me a text message to 864-800-9251. I appreciate you spending a little time with me to learn about this. If you're interested too, please reach out for any type of flyer pamphlet about that to learn more. Be more than happy to share with you. Go out and win the day, win the week. I appreciate you and what you do. Have a good one. Thanks. Take care. Bye-bye.